Hi, Rita. Thanks for joining me.
Thanks, Susie. Glad to be here.
Well, we get lots of questions from our clients about Roth conversions. So to level set, what exactly does it mean to convert to a Roth, and why would you want to do this?
Well, converting to a Roth means that you take contributions to your traditional IRA or 401k and you move them to a Roth. You may need to pay taxes on the amount you convert, but it allows you to take advantages of the benefits of a Roth, which are potential tax-free withdrawals, no required minimum distributions, and tax diversification of retirement assets.
Those are some good considerations. And we know every client's situation is unique. But can you give us some guidance on who might want to consider a Roth conversion?
There are a few questions to consider. First, are you still working? If so, you might want to contribute to a Roth 401k if your plan allows for it. And that's because there aren't income limits to contributing to a Roth 401k like a Roth IRA. Second, do you expect to pay higher taxes in the future? If you think that you'll be in a higher tax bracket after you retire, you may want to consider a Roth conversion. Third, do you plan to leave a substantial amount of your retirement assets to your heirs? If so, they may appreciate the tax-free nature of Roth IRA distributions. Lastly, can you pay the taxes on the conversion? This is one of the most critical factors when considering a Roth conversion. You'll need to be sure you can pay the current income taxes related to any taxable Roth conversion. A one-time conversion of a current balance in your account would result in taxes on the taxable portion. And keep in mind, the amount you choose to convert will be taxed as ordinary income in the year you convert, which can push you into a higher tax bracket.
So if someone thinks a Roth conversion might be a good strategy for them in a given year, how can they decide when to do the conversion and how much of their savings to convert?
Determining the right amount to convert in a year is heavily dependent on your income for the year, and then understanding which tax bracket you'll be in, which is why it's generally best to look at this at the end of the year when you have a picture of your income. From there, you'll want to analyze different conversion amounts and its impact on how it might increase your income and potentially your tax bracket. For some people, they may want to convert enough just to stay within their expected tax bracket. And this is complex, and you may make a mistake. So it's best to consult with a financial professional or tax advisor who can work with you to identify the best approach for your specific situation. You can also check out our Roth conversion calculator.
Well, are there any potential downsides or reasons not to do a Roth conversion?
If you don't think you can pay the taxes associated with a Roth conversion with money outside of a Roth, then a conversion may not be right for you. And that's because you want to make the most of the money you're converting to a Roth. Second, if you think you'll need to tap into your Roth within the next 5 years, then it may not make sense, as you must observe a 5-year aging rule in order to be eligible for tax-free distributions, unless you qualify for an exemption, such as turning age 59 and a half. And keep in mind, because Roth conversions are taxed as ordinary income, it can push you in a higher tax bracket, which can result in surtaxes and surcharges. For example, premiums for Medicare Part B and D have a surcharge called IRMA, which is why you'll want to carefully manage your tax bracket when it comes to a Roth conversion.
Rita, this is so helpful. And as you mentioned, there are income limits to contribute directly to a Roth IRA. A strategy called backdoor Roth might help in those cases. Can you explain how this works?
This is a common question. A backdoor Roth isn't a different kind of IRA. It's a backdoor way of moving money into a Roth IRA, since many people's income limits prevent them from what we call the front door method, which is directly contributing to a Roth IRA. And you can do this in 2 ways. One that uses your IRA and one that is allowed through some workplace retirement plans. A backdoor Roth conversion through an IRA is accomplished in 2 steps. First, making a non-tax deductible contribution to a traditional IRA, and then second, converting those funds into a Roth IRA. This is different from a traditional Roth conversion, which is the transfer of tax deductible contributions in a traditional IRA to a Roth IRA. And then there's the mega backdoor Roth conversion. This strategy also allows for 2 steps, but it involves your workplace plan. First, you would make an after-tax contribution to your 401k or other workplace retirement plan, and then you would do a conversion either to a Roth IRA or Roth 401k. But please note that not all plans allow after-tax contributions or conversions. And there's one difference with after-tax 401k contributions. It's different from a Roth 401k contributions because after-tax contributions may enable you to save in your workplace plan beyond the annual contribution limit for pre-tax and Roth contributions, which is why it's referred to as a mega backdoor Roth.
Rita, thank you so much for all this important information.
Thanks so much for having me.
If you want help with anything we discussed, reach out to your Fidelity representative. And for more timely news and thinking from Fidelity's top thought leaders, subscribe to Insights from Fidelity Wealth Management. I'm Susie Allen. Join me again soon.